Welcome to our deep dive into Tesla's Q1 2026 earnings report. Today, our whole mission is to understand this massive, honestly unprecedented pivot.
Because the numbers on paper, they're great.
Oh, they crushed it. As an electric vehicle maker, they absolutely crushed it. Earnings per share hit 41 cents, completely clearing the 37-cent estimate. Revenue grew, what, 16% year over year?
Yeah, to 22.38 billion.
Right. And those gross margins that everyone's just sweating over during the brutal EV price wars lately, they spiked to a surprisingly healthy 21.1%.
And, that's exactly why the stock initially popped 4%. Investors looked at that 21% margin and thought, okay, thank God the price war is over. They've stabilized the ships.
But then
CFO Vaibhav Taneja got on the earnings call and dropped a complete bombshell.
a $25 billion bombshell.
Exactly. A capital expenditure guidance for 2026 of $25 billion.
Just like that, the stock reversed,
Oh.
wiped out all those initial gains, because that single number completely reframes what this company actually is. Right?
Oh, entirely. We are watching a live, incredibly high-stakes transition. They are morphing from a traditional EV manufacturer into what is essentially a highly capital-intensive AI, robotics, and, well, semiconductor company.
And the question you have to ask yourself as you're listening to this is like, is this a brilliant visionary bet, or is it just an incredibly risky attempt to outrun a car market that's getting saturated?
Well, to answer that, we really have to look at the cash engine that's funding this whole $25 billion future. Because obviously, before you can spend that kind of money, you have to make it.
Makes sense.
And the reality of their automotive segment right now is it's incredibly complex. Let's look at how they actually pulled off those impressive automotive margins, which, by the way, came in at 19.2% even after you strip out the regulatory credits.
Right. And just to be clear, the regulatory credits are the money legacy automakers basically pay Tesla because they don't sell enough clean cars themselves.
Exactly. It's free money for Tesla.
So even without that free money, hitting 19.2% is a massive recovery. How did they structurally actually pull that off?
It mostly comes down to a few distinct operational shifts. First, you have raw material deflation, like the cost of lithium and other key battery commodities dropped significantly.
So immediate relief on the cost of goods sold.
Right. Plus, there was an early refund on some international tariffs. But honestly, the real structural driver for Q1 was geography.
Geography?
Yeah.
You're talking about the production split, right?
Yeah, exactly. If you look at the Q1 data, a staggering 60% of all deliveries were manufactured in China. That is a vital metric to keep in mind.
Because it's just cheaper to build there.
Way cheaper. Tesla enjoys radically lower production costs at their Shanghai Gigafactory compared to, say, Berlin or Texas. The local supply chain there is just hyper-optimized.
Right. Parts don't have to travel across oceans or anything.
No, they are built in the exact same industrial park. And obviously, the labor is cheaper. So mathematically, they simply make far more profit on every single vehicle that rolls off that specific Chinese line.
Okay, so the cost to build drops, which pads the margin. That looks brilliant on a spreadsheet.
Yeah.
But if you dig just one layer deeper into the actual delivery numbers, the narrative really starts to crack, doesn't it?
It does. It gets a little concerning.
Because the production numbers show they built 408,000 vehicles in the quarter. But they only delivered 358,000. I mean, that is a 50,000 car gap. If consumer demand is actually as robust as those margins suggest, where did those 50,000 extra cars go?
Well, they went straight into inventory. They're just sitting on lots or, in transit on ships. And that is the bearish reality check that immediately had Wall Street analysts sweating.
Oh, yeah, I bet.
Global inventory has just ballooned. It's up to 27 days of supply right now. To put that in perspective, just 3 months ago, that number was sitting at 15 days.
Wait, so they almost doubled the amount of unsold metal they're carrying in a single quarter.
Exactly.
It has to be dragging down their efficiency.
It totally does because, inventory costs money to store. And cars depreciate the longer they sit around. But what this really highlights is a massive regional disparity in where the demand is actually coming from. In China, sales surged 46% in March. It is a booming market for them right now. People are highly receptive to the product. But the U.S. market is seriously dragging.
And the data in the sources points to a very specific, totally non-automotive reason for that U.S. drag.
Yeah, it does.
It seems the CEO's high visibility role in the DOJ government efficiency project is creating a measurable impact on brand perception. Now, obviously, we're not taking a side on the politics here, but the metrics show this is acting as a real near-term drag on U.S. volumes.
Especially in those traditionally strong early adopter EV markets like California.
Exactly. When a brand becomes entangled with polarizing political projects, regardless of what the project is, it inevitably alienates certain key demographic segments.
Yeah, that brand entanglement is a real headwind for the Model 3 and Model Y right now. But the inventory issue isn't just limited to those legacy vehicles. We also really have to look at the Cybertruck.
Oh, the Cybertruck. I feel like this is a fascinating case study in building something before the market actually asks for it.
That's a good way to put it.
The data shows Tesla has aggressively ramped up their Cybertruck manufacturing capacity, right? To the point where they can build 125,000 of them a year.
Right.
But the broader consumer market acceptance just isn't there to match that supply. Instead of organic consumer demand clearing the lots, Tesla has actually resorted to selling excess Cybertrucks to other Musk-affiliated companies just to absorb the capacity. It's almost like a forced family purchase.
I mean, it's a mechanism to clear inventory, certainly.
But it's not a sustainable business model. You can't just build an enormous, highly specialized factory to make a hyper-niche stainless steel truck and then rely on selling them to your own corporate cousins because mainstream buyers aren't biting at that price point.
No, it solves a short-term capacity issue, but you're absolutely right. It is not a long-term demand generation strategy. And this really brings us to the core reality of their automotive segment right now. It is fundamentally capacity constrained by a saturated market. Now, to be fair to Tesla, they're still generating incredible cash. I mean, they pulled in an unexpected $1.4 billion in positive free cash flow this quarter alone.
Which is an undeniable achievement.
It is, but the fundamental growth curve of selling traditional electric vehicles is flattening. They can build more cars than the market currently wants at a price that maintains those 21% margins.
So they're stuck.
Sort of. To justify their massive valuation, they can't just be a highly profitable car company that grows at 5% a year. They urgently need a completely new growth story.
So if you hit a ceiling in your current market, but you happen to have, say, $44.7 billion in cash sitting in the bank, what do?
You go out and buy a completely different future.
Exactly. Which brings us right back to that number that rattled Wall Street, the $25 billion capital expenditure.
We really need to pause and put the sheer scale of that number into context, because this isn't just a routine upward adjustment. This is a $5 billion upward revision from the guidance they gave investors just 3 months ago.
Wait, they just found an extra $5 billion they suddenly decided they needed to spend?
Yes. And historically, $25 billion is roughly 3 times their annual spend. I mean, in 2025, their CapEx was $8.5 billion.
Think about that leap. I was thinking about it like, if you run a successful railroad, an $8.5 billion CapEx is like laying down new tracks and buying better trains. A $25 billion CapEx isn't an upgrade. It's deciding to start an airline while the trains are still running.
That's a great analogy.
And on the earnings call, Elon Musk tried to justify this scale by comparing Tesla directly to the big tech giants, right? He pointed out that Amazon is projecting to spend $200 billion on infrastructure, and Google is spending maybe $185 billion.
She did make that comparison, yeah.
But that comparison feels a little strained to me. Tesla is an automaker. Amazon has AWS printing money. Google has global search monopolies. Is Tesla trying to play in a tech giant league that their underlying automotive margins just fundamentally can't support?
See, that is the multi-billion-dollar question dividing analysts right now. And to figure out if they can actually afford it, we have to look at the mechanics of where that $25 billion is actually going. Because they aren't just funding one new initiative.
Right, they're doing a bunch of things at once.
Yeah, they're funding 3 simultaneous massive infrastructure futures.
Okay, let's unpack the first one, energy and compute.
Right. So on the energy side, they are building a massive new megafactory in Houston, specifically for the Megapack 3, which is their utility-scale grid storage.
Okay.
And that is actually a highly profitable business that gets very little attention. But alongside that, they are pouring billions into raw AI infrastructure. They just brought the Cortex-2 cluster online in Texas.
What exactly is that?
It's a gigantic supercomputer installation. It's required to train the neural nets for their autonomous driving and their robotics.
Which, I mean, makes sense mechanically. You need massive digital brains to run physical robots.
Yeah.
And those brains require billions of dollars in servers, power routing, and advanced cooling systems. Autonomy isn't really a car problem anymore, is it? It's a massive data processing problem.
Exactly.
But compute is basically just buying servers from someone else. The second initiative is way more aggressive. They are moving directly into semiconductor fabrication.
Yeah, this is perhaps the most surprising strategic pivot of the whole call. Tesla is no longer content just buying chips from NVIDIA and waiting in line for their allocation. They are building a massive semiconductor research and manufacturing facility in Austin that they are calling the Terafab.
Okay, what exactly happens inside a terafab, and why take on the astronomical cost of building your own silicon?
It's essentially a dedicated chip foundry. And the data from the sources reveals a really crucial partnership here. Tesla is partnering with Intel. Specifically, they're going to be the first major customer for Intel's highly advanced 14A manufacturing process.
Wait, Intel? So they aren't going to TSMC in Taiwan, which makes almost all the high-end chips right now.
Exactly. TSMC is largely booked up by Apple, NVIDIA, and AMD. If Tesla believes the entire future of their company relies on deploying tens of millions of AI devices between the cars and the humanoid robots, they just cannot be at the mercy of global semiconductor supply bottlenecks.
That makes sense.
They want to vertically integrate logic, memory, and advanced packaging all in-house for their new AI5 inference processor.
Let's actually explain why that advanced packaging part matters so much for AI, because it's not just about making the chip smaller, right? It's about how the components talk to each other.
Precisely. In AI, the bottleneck isn't usually the processor's speed itself, it's how fast you can move data from the memory to the processor. Advanced packaging allows you to physically stack the logic and memory chips incredibly close together.
So it reduces latency.
It reduces latency, but more importantly, it drastically reduces power consumption. If you are trying to build a battery-powered humanoid robot, power efficiency is literally everything. You need custom silicon to pull that off. And they've already completed the tape-out, which is the final design phase for this chip.
Wow. But deciding to fabricate your own custom 14A silicon and building out massive supercomputer clusters has a brutal, immediate financial consequence.
It really does. And to his credit, the CFO, Vaibhav Taneja, didn't try to hide it at all. He issued a very stark warning. Because of this massive $25 billion spend, Tesla expects to run negative free cash flow for the remainder of 2026.
They are willingly going to bleed cash for the rest of the year. I mean, they built up that $44.7 billion war chest specifically for this moment, and now they are aggressively deploying it.
Yeah, it is a calculated gamble. They're betting that the eventual return on investment in AI and robotics will completely dwarf whatever incremental profit they could make just trying to sell slightly more Model Ys.
Exactly. But here is where the narrative of the earnings call takes a really fascinating turn. Because with billions of dollars literally flying out the door to fund these sci-fi initiatives, you would expect the standard Elon Musk playbook.
Oh, for sure. You'd expect massive hype.
Right. Promises that robotaxis will be replacing Ubers next month, and that human labor is about to be totally obsolete by Christmas.
Right, but that didn't happen. The tone of this specific earnings call was completely different. There was a highly unusual injection of restraint.
Restraint from Musk.
Yeah, he was actually preaching patience. He specifically warned investors to expect a, and this is a quote, stretched S-curve for the production of the Cybercab and the Semi.
A stretched S-curve. That is classic corporate speak for the technology works, but scaling the manufacturing is going to take a lot longer and be a lot harder than you want it to be.
Exactly.
And this sudden burst of realism really came into focus when they detailed the operational plan for Optimus, right? Their humanoid robot.
The retooling plan for Optimus is one of the most complex physical challenges they've ever attempted. Their stated goal is to produce 1 million robots a year for the first generation line.
1 million robots.
But to do that, they aren't just building a new facility in an empty field somewhere. They are completely halting the legacy Model S and Model X production lines at their original factory in Fremont, California.
Wait, they are actively killing the production of the flagship luxury cars that literally built the brand.
Yes, they are going to tear down those massive automotive assembly lines and completely rebuild the footprint as a robotics factory. And Musk himself admitted on the call how incredibly difficult this physical reality is.
Yeah, I saw that. He actually tried to manage expectations down, which is so rare. I mean, he basically said he was injecting some realism. He said, frankly, if we can halt production of a line, dismantle the entire production line, reinstall a completely new one, and get it up and running within 4 months, That would be an incredibly fast pace.
And you really have to think about the mechanics of why that takes so long. I mean, you can't just take a massive robotic arm designed to spot weld a 4,000-pound steel car chassis and just reprogram it to assemble the delicate, millimeter-precise actuators of a humanoid robot.
Right. The physical tolerances are completely different. I mean, you have to rip up the concrete to change the power routing. You have to change the entire supply logistics of the factory floor. You are literally bringing in new robotics to build the robots.
It's a massive undertaking.
But looking at this massive disruption, you have to ask, is there even a proven consumer market for 1 million humanoid robots a year right now? Or is Tesla willing to dismantle its legacy manufacturing just to keep the futuristic valuation narrative alive on Wall Street?
See, that is the exact debate splitting analysts right now. The bears look at the Fremont teardown and argue it's just a narrative distraction from a saturating EV market.
And the bulls?
The bulls argue that if you successfully solve generalized physical AI, the total addressable market isn't just people who want to buy a car. The market is the entire global labor force.
Wow.
But as you pointed out, the timelines for that transition are going to be incredibly messy.
And it's not just the hardware that's messy, right? The software running the autonomy is equally complex. The autonomous software race is really the second half of this massive bet.
And they're making undeniable progress there. Full self-driving, or FSD supervised, just hit 1.28 million subscribers.
Okay, but we have to add a critical caveat to that number from the sources. That 1.28 million isn't just people paying $99 a month right now in recurring revenue.
Right.
That figure actually includes legacy customers who purchased the software outright years ago for a flat fee. So it really muddies the waters a bit on how much actual subscription cash flow that software is generating today.
It's a very important distinction for the balance sheet, for sure. But technologically, the footprint is expanding. I mean, they've officially launched unsupervised robotaxi rides in Dallas and Houston.
Unsupervised, meaning no human safety driver behind the wheel at all.
Exactly. It's a massive regulatory and technical milestone.
Yeah.
Furthermore, and on top of that, they just secured approval to deploy FSD in the Netherlands.
Oh, wow.
Which effectively wedges their foot into the door of the highly regulated European Union market. And Musk promised that the impending version 15 of FSD isn't just a standard update. It is a complete architectural overhaul designed to make the current neural nets look obsolete.
It's the classic Silicon Valley strategy applied to heavy industry, isn't it?
Yeah.
Just keep iterating your software so fast that you outrun your competitors' hardware.
That's the plan.
But as we step back and look at all these moving pieces, the recovering margins, the bloated inventory, the U.S. drag, the $25 billion tariff fab, the robot factories, what is the ultimate takeaway for you?
The takeaway is that Tesla is attempting one of the most audacious structural metamorphoses in modern business history. I mean, Q1 2026 proved that they know how to build and sell electric cars profitably. The EV price war stabilization is great, but it's essentially a sideshow now.
The main plot has moved on.
Exactly. The real plot is that Tesla is willingly plunging itself into negative free cash flow, spending a historic $25 billion in a single year to transform into an AI and robotics juggernaut.
So they basically figured out the car business, got bored, and decided to try and solve artificial general intelligence instead.
I mean, pretty much. They're building terafabs, partnering on 14A chip nodes, buying tens of thousands of supercomputer processors, and literally tearing down the very car factories that made them famous.
Which leaves us with a really provocative thought for you to take away today. If this massive gamble actually works out, if Tesla successfully corners the market on humanoid robotics and scales the cybercab and masters in-house AI semiconductor fabrication, will we look back at the Model 3 and the Model Y 10 years from now, not as the core of their business, but just as the first stage booster rocket?
Oh, that's interesting.
Like a vehicle that solely existed to generate the $44 billion in cash needed to launch their true ambitions, and was then simply discarded once they finally reached orbit.
It completely changes how you view the company. The cars were never the end game. They were just the funding mechanism for the AI.
Exactly. Something to mull over the next time you see a Tesla waiting at a stoplight next to you.
Ah.
Thank you for joining us for this deep dive. Keep looking beneath the surface of the headlines, and we'll see you next time.